Welcome to Course 10 of the Oregon Third-Party Verification Program. My name is Chintan Trivedi and I am the reporting specialist for the Clean Fuels program. Today we will cover the verification process for quarterly fuel transactions reports under the Clean Fuels program. This training is critical for those involved in the verification of fuel transactions. It helps ensure that Oregon's goals of reducing greenhouse gas emissions from transportation fuels are met. If you have any questions during the session, feel free to contact us at 3pverify@deq.oregon.gov. This course is divided into three modules. Module 1 gives a general overview of the reporting framework. Module 2 discusses the responsibilities of regulated parties and the reporting requirements. And Module 3 focuses on the same for the credit generators. These modules are designed to provide a full understanding of the Clean Fuels program reporting and verification process. In Module 1, we will cover a broad overview of the quarterly fuel transaction reports. This will include an understanding of the reporting framework, key reporting requirements, and general verification criteria. Our goal is to provide clarity on how the reporting process is structured. Let's talk about the reporting entities. The reporting entities in the Clean Fuels program include both liquid and non-liquid fuel providers. These are made up of three groups: regulated parties, credit generators, and aggregators. The regulated parties are responsible for complying with the clean fuel standards because they import and handle regulated fuels. The credit generators are the ones who provide clean, low-carbon fuels and generate credits, and the aggregators are the ones who facilitate other companies participating in the Clean Fuels program by reporting on their behalf and trading their credits. Reporting entities are crucial in the Clean Fuels program as their participation, mandatory or voluntary, is how we implement the requirements to reduce greenhouse gas emissions from Oregon's transportation sector. Regulated parties are entities that produce or import fuels like gasoline, diesel, biodiesel, ethanol, renewable diesel, and components or blends of these fuel types which are predominantly used for transportation. Any other transportation fuel, whether liquid or non-liquid, also falls under this category. These entities must ensure accurate reporting and compliance with the Clean Fuels program. Credit generators are entities that provide fuels like renewable and fossil propane, electricity, hydrogen, alternative jet fuel, and renewable and fossil natural gas, though the latter, that is fossil natural gas, will transition to a regulated fuel in the coming years. These entities voluntarily participate in the program to generate credits by providing clean fuels in Oregon. Let's now look at the Oregon Fuels Reporting System, or OFRS. The OFRS is the platform for quarterly and annual reporting of fuel transactions. It is also used for credit and deficit calculations, compliance demonstrations, and banking credits. Reporting entities submit quarterly and annual reports through the system, while verifiers review the accuracy of the reported information. It is also used for the greenhouse gas reporting programs, fuels reporting in Oregon, and by alternative fuel producers to register and report on fuel pathways. In the OFRS, reporting entities can manually enter data or upload templates. This allows for flexible reporting of both liquid and non-liquid fuel transactions. For manual entry, entities input their transactions directly into the system. And for uploading a file, entities can use XML or Microsoft Excel templates to upload their data. These templates are designed to accommodate both liquid and non-liquid fuel types, that is, FSC and non-FSC related transactions. FSC stands for Fuel Supply Equipment. Quarterly reporting follows a strict schedule, except that we will move the due date if it falls on a weekend or a public holiday. In those cases, it will be moved to the next business day. Fuel transactions for each quarter must be reported in the next quarter. The date when a transaction must be reported is when it actually happens legally, such as a transfer must be reported when the fuel changes ownership from one party to another and not when the invoice was generated. For example, if a position holder invoiced a sale of fuel to a below-the-rack entity for a date close to end of Q1, but the title transfer or the ownership transfer and physical pickup of the fuel took place in Q2, then the transaction date will be the date when the title or ownership was transferred, that is Q2. The key deadlines for quarterly reports are June 30, September 30, January 10, and March 31. It is important for the reporting entities to meet these deadlines to avoid enforcement action and ensure that credits can be generated. The quarterly reporting process is divided into two phases. In the first 45 days of the calendar quarter, entities must upload their transactions data into OFRS for the open reporting period. And in the second 45 days, they must reconcile their data with their business partners. Transactions reconciled during this time are generally not subject to verification, but they may still require review to ensure all reported details are accurate. Annual verification is mandatory for all quarterly reports submitted to the Clean Fuels program, where the reporting entity, and where applicable its related entities, are above the threshold for verification. During the annual verification, verifiers assess the accuracy of reported fuel quantities and ensure that there are no material misstatements. A site visit is also required unless the reporting entity is approved for a less intensive verification. During the site visit, verifiers assess the accuracy of the data and the system used to track transactions. All fuel transactions must be backed by a product transfer document, PTD, that include fuel quantities associated with its Certified Fuel Pathway Code, FPC. The annual verification process has its own deadline, which is August 31. Unless the due date falls on a weekend or a public holiday, in which case it will be moved to the next business day. By this date, the verification body must submit a verification statement to DEQ. Please note that it is important for the reporting entity to submit any corrections identified during the verification process by early to mid-August. This ensures sufficient time for both the verifier and DEQ to review and process any changes. Though the focus is on annual verification, entities may choose to engage in a quarterly review to identify issues early. In the context of annual verification, quarterly reviews are allowed for annual fuel pathway reports, which are discussed in Course 9, and quarterly fuel transactions reports. As mentioned earlier, though the focus is on annual verification, entities may choose to engage in a quarterly review to identify issues early. This allows them to address potential errors throughout the year rather than waiting for the annual review. Errors or issues identified during the quarterly review must be documented and incorporated into the risk assessment and sampling plan for the annual verification. This ensures that all necessary checks and data validations are performed across the reporting year. When performing a site visit, the verification team must confirm the existence of the individual fuel supply equipment FSC, but site visits to those FSC are not required. They must review the reported data and interview key personnel. Verifiers must review data management systems and inspect production measurement equipment. This helps confirm the accuracy of reported fuel transactions and ensures compliance with measurement standards. Material misstatement refers to any discrepancies in reported fuel quantities that result in more than a 5% overstatement or understatement for each transaction type under applicable fuel pathway code per quarter. All errors must be corrected before the verification process is completed in order for a positive verification statement to be issued. To calculate a material misstatement, verifiers assess the reported fuel quantities for each transaction type under applicable fuel pathway code per quarter. Any discrepancy 5% or higher must be addressed to maintain compliance. As we move forward, let's discuss the transaction types that are subject to verification under the Clean Fuels program. For liquid fuels, the transaction types that are subject to verification are produced in Oregon, out-of-state production for import, the four import transaction types: exports out of Oregon distribution system, gain of inventory, loss of inventory, not used for transportation, and exempt fuel uses. Please note that NGV fueling and propane fueling transaction types are also subject to verification. Entities must ensure all data for these transactions are accurately reported and documented to avoid any enforcement actions. Crude oil-related fuel transactions do not require quarterly or annual reporting under the Clean Fuels program. However, some transactions like position holder sales and certain alternative fuel transactions may still be subject to greenhouse gas reporting program verification. Electricity and hydrogen fuel related transaction types are not currently subject to verification, but electricity has been proposed to be subject to verification in an active rulemaking. Accurate record keeping is critical for ensuring compliance. Entities must retain all documents related to fuel transactions, such as product transfer documents, or PTDs, copies of data reported to the DEQ, chain of custody evidence for fuels imported into Oregon, and attestations regarding environmental attributes associated with book and claim accounting for biomethane. Please note that under the Clean Fuels program, records must be kept for a minimum of 7 years. This ensures a thorough paper trail and accountability for all fuel transactions. In this next section, we will dive into Module 2, which covers the reporting requirements for regulated parties. These requirements are designed to ensure that the quarterly fuels reporting of the regulated fuel types subject to verification are in compliance with the Clean Fuels program. For regulated parties, several key parameters are subject to verification, including the type of transaction, fuel application, fuel pathway code, and the fuel volume reported per fuel pathway code. Additionally, documentation requirements are crucial when transferring ownership of fuel, especially as outlined in OAR 340-253-0600. Product transfer documents are essential for verifying ownership and transaction accuracy. All these parameters must be checked to ensure compliance. To understand reporting and verification, it is essential to understand some key terms. One such term is terminal. It is a fuel storage and distribution facility supplied by a pipeline or vessel, or co-located with a production facility, which can distribute fuel directly to retail sites or end users. Terminals do not include intermediate storage sites, which are generally places where fuel is stored outside of a terminal by a single company that then distributes the fuel to its customers. Then there is the bulk system, which refers to the entire fuel distribution system, including refineries, pipelines, vessels, and terminals. Fuel storage and blending facilities that are not directly fed by pipelines or vessels are not considered to be in the bulk system. That is, they are considered outside of the bulk system. Another important term is position holder, which refers to anyone who has ownership interest in a specific amount of fuel within a terminal operator's inventory, but it does not include inventory held outside of a terminal, such as at retail locations or other fuel suppliers. This term was added to the Clean Fuels program when reporting was combined with the Greenhouse Gas Reporting program using the online fuels reporting system, that is OFRS. A multiple party sale refers to when a position holder sells fuel to a company below the rack, which then sells it to another company, and this process may continue. In some cases, these are called flash sales, where quick transactions occur between multiple parties. Understanding these terms is critical for accurate reporting. This slide lists all of the fuel terminals in Oregon as determined by the Oregon Department of Transportation, which play a crucial role in the state's fuel distribution system. This list can be used to determine if the location where fuel is being delivered falls within the bulk system. For verifiers, understanding these locations is essential for the verification of fuel transactions reporting. Please note that in-state producers are not included on this list, but airport terminals are. If entities are position holders of fuel at these terminals, they must report those fuel volumes as they would for any other position holder transaction. Next, we will discuss specific transaction types that require verification. These include fuel produced at a facility in Oregon, that is, production in Oregon; out-of-state fuel production for import into Oregon, that is, out-of-state production for import; and fuel imports within and outside the bulk system, that is, import within the bulk system and import outside the bulk system. There are also two additional transactions for imports of gallons that have been previously reported as production for import. They follow the same breakout as the other two, with imports inside and outside of the bulk system. These are importing production for import gallons inside of the bulk system and importing production for import gallons outside of the bulk system. Other key transaction types that require verification includes export out of Oregon distribution system, which reports when fuel that was reported under the Clean Fuels program was later moved out of Oregon. Then gain of inventory and loss of inventory, which reports when fuel was added or removed from the Oregon fuel pool. These transaction types are relatively rare and are often used for reporting fuel that was spilled or otherwise no longer meets the fuel specification, or to allow a reporting entity to move fuel between fuel pathway codes when that fuel's CI was modified by DEQ after a fuel pathway application or annual fuel pathway report. CI here refers to carbon intensity. Additionally, there are transaction types for fuel not used for transportation, such as for fuel for stationary process heat or electric power generation, and transaction types for exempt fuel uses like military vehicles or agricultural equipment. Here we will look at transaction types that do not require verification. These include transactions involving sales or purchases of fuel with or without compliance obligation, that is, sold or purchased with or without obligation. Please note that with obligation means the purchaser assumes the compliance obligation, and without obligation means the seller retains the compliance obligation. In addition to these, transaction types involving position holders that are not subject to verification under the Clean Fuels program but may still require verification under the Greenhouse Gas Reporting Program. These include position holder sales without obligation or purchase below the rack for export. As we move forward, we will focus on the fuel application types that are subject to verification. Each fuel application type has an associated energy economy ratio, EER, which compares the efficiency of alternative fuels to gasoline or diesel. The EER values are tied to the fuel application type selection, meaning reporting entities cannot alter it unless they change the fuel application type. While EER values themselves, as listed in Table 7 of the regulation, are not subject to verification, the fuel application type is, and the selection of the correct fuel application type for each transaction is critical. Misreporting of these fuel application types can affect credit and deficit calculations in the Clean Fuels program, so it is essential that they are selected accurately. For liquid fuels, we would generally expect light-duty vehicle to be selected for gasoline and ethanol, and heavy-duty vehicles for diesel, biodiesel, and renewable diesel. All reported fuel volumes are subject to verification. Quarterly reports must include the volume of each fuel type in gallons reported for each distinct fuel pathway code. This means each fuel pathway code associated with a specific carbon intensity value must have its fuel volume reported separately. The fuel types covered include gasoline, diesel, biodiesel, ethanol, renewable diesel, and their blends, along with other fuels listed in the program. It is also important to provide the production company and facility ID for biofuels, which are subject to verification for biofuels. Liquid fuel volumes must be reported at standard temperature conditions, which is 60 degrees Fahrenheit. This is commonly referred to as net gallons on bills of lading and other transaction documents. For ethanol and biodiesel, the correction formulas to adjust fuel volumes to 60 degrees Fahrenheit are provided in regulations. For other liquid fuels, entities should apply industry best practice methods for adjusting volumes to standard temperature conditions. Accurate volume reporting is critical to ensure correct credit or deficit generation and compliance with the program. Every fuel transaction must be documented using a product transfer document, that is PTD, as per the regulations. A PTD is a document or set of documents that proves the transfer of ownership of fuel between parties. It must include critical information identified under OAR 340, 253, 0600, subsection 2, and are listed in the next slide. PTD is vital for both reporting and verification purposes and must be retained for 7 years. As mentioned earlier, a PTD must include several critical pieces of information to ensure accurate reporting. These include the names and addresses of the seller and buyer, the transaction date, the fuel pathway code, the fuel volume, and a statement indicating whether the compliance obligation has passed to the buyer. Additionally, for biofuels, the PTD must include the EPA Fuel Production Company ID and Facility ID from EPA's Renewable Fuel Standard Program. If the state where the fuel will be delivered is known, it must be included. If unknown, the PTD must state that the destination is unknown. All this information is essential for maintaining transparency and traceability in the transaction process. Substitute fuel pathway codes may be used when the seller does not pass along the credits or deficits to the buyer, and they are not passing along the carbon intensity of the fuel or its blend stocks. These substitute pathway codes are used for transactions such as exports, loss of inventory, non-transportation fuel use, exempt fuel use, and sales or purchases without compliance obligations. It is crucial that the appropriate substitute fuel pathway code from Table 8 under the regulations is used when reporting these transactions. Misuse of these codes can lead to reporting errors and compliance issues. When fuels are transferred into and out of commingled storage tanks, entities may use mass balance accounting to allocate fuel pathway codes. This method allows the assignment of fuel pathway code based on the volume of fuel input into the tank during the current or prior quarter. Unlike California, which allows mass balancing over 3 quarters, Oregon only allows it for the current or previous quarter. This method is essential for reporting when multiple fuel types are stored together. Under the two-quarter rule, liquid gallons reported under a specific fuel pathway code can only be recorded as transferred out if they were added to the commingled tank within the last two quarters. This ensures that the fuel volume reported matches the fuel types added in the previous quarters, maintaining accuracy in the fuel reporting process. For biofuels that were reported with a temporary fuel pathway code upon purchase, the same temporary fuel pathway code must be used when removing fuel from commingled storage. Maintaining this two-quarter rule is essential to ensure fuel volumes are accurately reported. Fuel exports must be reported by the entity holding the title when the fuel leaves Oregon. This could be the entity that originally imported the fuel, or another entity purchasing it directly from the position holder at the rack. This also applies to situations where fuel is sold below the rack, then exported by another party. The correct transaction types, related single-party or multiple-party transactions, must be selected in the OFRS to ensure compliance. Reporting export transactions accurately is critical and must be tracked for compliance purposes. In cases where the position holder sells fuel to a company that does not report to the Clean Fuels Program but exports the fuel, the position holder must report the export. In this case, the position holder must report export out of Oregon distribution system and must tag the transaction with undefined as the business partner and include the name of the company that exported the fuel in the description column. In cases where the position holder sells fuel to a company that report to the Clean Fuels Program and that company sells fuel to another company that does not report to the Clean Fuels Program but exports the fuel, the company that bought the fuel from the position holder must report the export. In this case, the position holder must report position holder sale for export and tag the company that bought the fuel from them as the business partner. The company that bought the fuel from the position holder must report purchase below the rack for export and tag the position holder as the business partner. And then it must report an export out of Oregon distribution system and tag undefined as the business partner and include the name of the company that exported the fuel in the description column. Reporting these transactions accurately helps maintain transparency in the fuel supply chain and ensures compliance with both the Clean Fuels Program and the Greenhouse Gas Reporting Program. In case of diversions, if the fuel purchased from a position holder is later exported, the position holder must update the transaction type from a position holder sale without obligation to a position holder sale for export. Both the seller and buyer must keep detailed documentation regarding the diversion of fuel, such as emails and corrected bills of lading. This requirement applies even if the fuel is held at an intermediate storage site before export. For multiple party transactions, each intervening party must report the transaction of title using the appropriate sales and purchase transaction types, ensuring that the last entity in the chain reports the final export. When delivering or selling fuel to tribal reservations within Oregon, the transaction is treated as an export under the Clean Fuels Program. However, for the Greenhouse Gas Reporting Program, it is considered fuel used within Oregon. In these cases, the position holder must report a position holder sale without obligation, the buyer must report a purchase without obligation, followed by an export out of Oregon distribution system. Additionally, a note in the description field should indicate that the fuel is being delivered to a tribe or tribal lands within Oregon's border. When an entity exports fuel from Oregon after purchasing it from a position holder, both the position holder and the exporter must accurately report the fuel quantities its units, and the fuel pathway code. If the position holder has provided specific gallons for blended components, the exporter must match and report those quantities in the same manner. It is essential that both parties report their portions of the transaction correctly to maintain consistency and ensure transparency in the export process.
The Clean Fuels Program provides certain fuel use exemptions which are listed in our regulations. The exemptions apply to vehicles and equipment such as aircraft, racing vehicles, military tactical vehicles, locomotives, watercraft, and vehicles that are used on farms. Fuels used by these categories are not subject to the Clean Fuels Program because of those specific uses, and they have to be demonstrated to be used in those specific vehicles to be claimed as exempt. It's important to note that the entities claiming exempt fuel uses must provide clear documentation to justify the exemption, ensuring that the fuel used falls into one of those specific exempt categories. Entities claiming fuel as exempt must maintain thorough documentation. This can be done by either demonstrating that the fuel was sold through a dedicated source for exempt use, such as private accounts or card lock systems that track if an exempt vehicle is being fueled, or by having product transfer documents that clearly indicate the exempt use for that fuel. For example, a product transfer document could show that the fuel is being sold to military vehicles or to racing activities. Without this documentation, the exempt claim will not be accepted. Entities may choose not to claim fuel as exempt and instead voluntarily include it in their credit or deficit calculations for the Clean Fuels Program. However, once the reporting period for that quarter has closed, these volumes can no longer be claimed as exempt. If an entity opts for voluntary inclusion, it must report all fuel listed on the same invoice as included in the program. Once reported, the fuel is subject to the same verification and compliance requirements as any other fuel. This voluntary inclusion, again, must be finalized at the end of the reporting period for that respective quarter. When a position holder is selling fuel to an end user below the rack for exempt purposes, the sale to that exempt end user must be reported as both a position holder sale without obligation and then additionally an exempt fuel use transaction type for whatever exempt use that user has. This is not considered double reporting. Instead, it ensures that the correct gallons are captured for both the Clean Fuels Program and the Greenhouse Gas Reporting Program. As for Clean Fuels Programs purposes, it's reported as exempt, and for Greenhouse Gas Reporting Program, those gallons are still calculated and held as total position holder emissions for that entity. Position holder must include precise volumes for exempt fuel uses and for any of the blended components of that fuel. Here we're going to cover how fuel not used for transportation purposes, such as for stationary sources like generators or for heating oil or industrial processes, is reported. When fuel is sold for these purposes, the reporting entity must state the stationary source or category of fuel combustion in the transaction description field of OFRS when they're entering the transaction. This classification ensures that the fuel is not mistakenly included in the transportation-related emissions and credit calculations. Please note that this transaction type does not cover mobile equipment, such as transportation refrigeration units on trailers or off-road vehicles, such as bulldozers being used at a mine or snowcats being used as a ski area, and that the voluntary inclusion rules covered on the previous slide also apply here for this category. As always, the reporting entity is required to report the exact volume of fuel that is not used for transportation. For blended fuels, every component must be included in this reporting. When entities sell fuel as a position holder to a purchaser below the rack that is going to be using it not for transportation, then they must report the transaction with both the position holder sale without obligation transaction type and then the not used for transportation transaction type. This isn't double reporting. Again, as with the exempt fuels, reporting it this way ensures that the correct gallons are captured in OFRS for both the Greenhouse Gas Reporting Program and for the Clean Fuels Program. Energy economy ratios represent the efficiency of an alternative fuel compared to a reference fuel, such as gasoline or diesel, being used in a specific type of vehicle. For instance, a higher energy economy ratio indicates that an alternative fuel is achieving more miles per unit of energy compared to conventional fuels. Each fuel application type, such as light-duty vehicles, heavy-duty vehicles, or forklifts, for example, has a specific energy economy ratio, which is preset in the fuels reporting system. The reporting entity must select the correct vehicle and fuel application type for each transaction, as this determines the EER used in credit deficit calculations. And again, all fuel application types are subject to verification. Table 7 in OAR 340, 253, 8010, which is our tables rule, provides a detailed breakdown of the various fuel application types and their corresponding energy economy ratios. These values are integrated in the reporting system and cannot be altered. The reporting entity is only able to select the correct fuel application type and must select the correct fuel application type for each of their transactions. While the ER values themselves are not subject to verification, the application type selection is subject to verification and must be verified for accuracy during either quarterly reviews or just the annual check of the quarterly fuel transactions reports. Errors in selecting the appropriate fuel transaction type can lead to compliance issues if the reporting entity does it incorrectly. Okay, we are now moving into module 10.3, which focuses on credit generators. Credit generators play a vital role in the Clean Fuels program by generating credits for alternative fuels such as renewable natural gas, renewable propane, and electricity that are being used for transportation. These entities can include fuel producers, suppliers, and distributors, depending on the fuel type in question. For credit generators, there are several key reporting parameters that you'll need to check as the verifier. These include the transaction type, fuel application type, fuel pathway codes, and the fuel quantity that is being dispensed per fuel supply equipment. Additionally, for biomethane-based volumes, specific documentation is required when using a book and claim methodology, which is outlined in OAR 340, 253, 0640. Several transaction types related to natural gas vehicles and liquefied petroleum gas or propane fueling equipment require verification. For natural gas vehicles, the credit generators must verify the dispensing of natural gas at fueling stations, while for LPG or propane fueling, the fuel dispensing must also be verified. Additionally, there are alternative jet fuel transactions, but those transaction types follow the same reporting and verification requirements as liquid fuels, which were discussed in module 10.2. So we're not going to repeat those here. It's just that for alternative jet fuel, also known as sustainable aviation fuel, it's reported the same way as the other liquid fuels. Some transaction types, such as EV charging and hydrogen fuel cell vehicle fueling, do not currently require verification under the Clean Fuels program. Fuel supply equipment, or FSE, refers to the equipment used to dispense alternative fuels into vehicles, meaning electric vehicle chargers, hydrogen fueling stations, and equipment for dispensing fossil or renewable natural gas or propane. Credit generators register their fuel supply equipment to report the fuel they dispense, which then generates credits under the Clean Fuels program. For fossil CNG, which is compressed natural gas, and propane, the owner of the compressor or fueling equipment is responsible for reporting. For propane forklifts, it's the fleet owner or their designated aggregator. And for other transaction types, for other fuel types, it's the appropriate one, but those generally aren't covered by verification, so I won't go into them here. This slide focuses on the reporting requirements for LPG or propane transactions. Entities reporting LPG must adhere to the specific pathways outlined in the regulations, and generally they'll only use the FPC found in Table 4 for fossil LPG. If they're using renewable LPG, we'll cover that on the next slide. The amount being reported is in normal gallons, and it must be reported by FSC, which is by each individual fueling station for propane that entity is reporting for. For renewable propane, generally it's the same as for fossil in terms of selecting the correct fuel application type, being light duty vehicles, medium duty vehicles, propane, or so on. The quantity of fuel must be accurately reported, and with renewable propane, it will be generally a Tier 1 or Tier 2 approved fuel pathway code from a specific fuel producer. So the reporting entity must select the correct fuel pathway code, along with adding in the production company ID and facility ID for those renewable propane gallons, just as you would for a liquid fuel that's from a biological source. A quick note on biomethane or renewable natural gas before we talk about fueling and the transaction types for natural gas vehicles. For biomethane and renewable natural gas, reporting entities must generate and retire renewable thermal certificates in the MRETS renewable thermal system and attach them as supplemental documentation with their quarterly reports in Oregon. These certificates must cover the volume of fuel that was reported, and the producers must match the producers that for the corresponding fuel pathway codes that the reporting entity is using. Biomethane is, as a defined term, is just refined biogas or another stream of synthetic methane from renewable resources that has been upgraded and injected into the natural gas pipeline system. And it can also be used directly in natural gas vehicles. Biomethane injected into a North American common carrier pipeline may be matched with gas withdrawn in Oregon for transportation uses, and can also be used to produce hydrogen when it is being used as a transportation fuel in Oregon. And when using this book and claim system that we have for biomethane, the environmental attributes of the biomethane must be tracked and retired if someone is using it for transportation in Oregon and claiming credits under the Clean Fuels Program. The environmental attribute definition below is defined in CFP's rules and is a holistic definition. Biomethane being used in the program must contain all the environmental attributes, and they cannot be split between different uses. Entities reporting transactions related to natural gas vehicles must select appropriate CI values for their reporting, which for fossil natural gas are contained in Table 4 of our lookup table in OAR 340, 253, 8010. Renewable natural gas can be reported into several pathways that have been certified as either Tier 1 or Tier 2 pathways, or potentially for a new fuel producer are in the temporary fuel pathway code table. And then the quantity of dispensed natural gas can be allocated between renewable natural gas and fossil natural gas. For entities reporting compressed natural gas or liquefied to compressed natural gas, the reporting amount must be in therms per quarter and per fuel supply equipment. For entities reporting liquefied natural gas, the amount of fuel dispensed is reported in gallons per fuel supply equipment. Natural gas is reported separately for each fuel application type as listed in Table 7 of our tables rule. And generally for natural gas vehicles, it's going to be light duty or heavy duty vehicles with a distinction made between compression ignition engines and spark ignition engines. For renewable natural gas or biomethane, the reporting must also be accompanied by the correct EPA company ID and facility ID for the fuel pathways being used for that renewable natural gas or biomethane. Okay, now we'll go into how book and claim for biomethane or renewable natural gas in the Clean Fuels Program works a bit more. Book and claim generally refers to the chain of custody model in which we allow for the decoupling of environmental attributes from the physical transportation fuel. Environmental attributes are attached at the point when they're injected into the larger energy system and then are reattached when the fuel is being put into a specific vehicle, such as a natural gas vehicle in this case. These claims must be made in specific ways in order to maintain the environmental integrity of the program. And just a note that book and claim accounting cannot be used to claim any fuel that is used as process energy in the production of a transport fuel on the fuel pathway side of the program. An entity claiming the environmental attributes for renewable natural gas must demonstrate an exclusive right to claim them associated with the sale or use of biomethane through the use of renewable thermal certificates here in Oregon. The reporting entity must be able to link the environmental attributes of biomethane being injected with the corresponding quantities of natural gas withdrawn for transportation use here in Oregon. A unit of biomethane that is matched with a unit of natural gas dispensed at a fueling station may be claimed for both RIN generation under the Federal Renewable Fuel Standard and for CFP crediting. However, it may not be double claimed in other programs pursuant to OAR 340, 253, 0600, Part 6B. Examples of double claims prohibited under the Clean Fuels Program include, but are not limited to, a therm of biomethane may not be matched with a larger quantity of natural gas withdrawn. In those cases, they can only report the amount of renewable natural gas they actually have rights to, and then any larger amount must be reported as fossil natural gas. The same therm of biomethane may not be claimed as used in Oregon under the CFP and then claimed as being used elsewhere under the federal RFS or any other program. The same therm of biomethane may not be claimed as used at multiple CNG fueling stations in Oregon. A therm can only be used in one location. And the same therm of biomethane may not be claimed as feedstock for hydrogen production and then separately claimed as being dispensed for natural gas vehicle fueling, regardless of whether that hydrogen production or the dispensing location is inside or outside of Oregon. A therm can only be used once. So just to be clear, this is a difference from California where they allow for 3 quarters. But here in Oregon, we only allow for 2 quarters from when renewable natural gas is injected into the North American natural gas pipeline system, and then when it's withdrawn and used against vehicle fueling here in Oregon. So for example, if a quantity of biomethane is injected in the first calendar quarter of a given year, it can be matched with natural gas vehicle fueling in the first quarter or the second quarter of that year here in Oregon. After the second quarter reporting period is over, any unmatched biomethane quantities expire for CFP purposes. For example, biomethane injected into the pipeline in January may be matched with natural gas vehicle fueling as late as June, but once July rolls around, then it's expired and can no longer be used, and you would need to find renewable natural gas that had been injected in April or later to be used in June. For book and claim for both renewable natural gas being used as transportation fuel or as a feedstock for hydrogen production, you need to meet the following conditions. Biomethane has to be injected into a North American common carrier pipeline that has some sort of connection to Oregon. The 2-quarter limit, as I discussed on the previous slide, applies. And then documents linking the environmental attributes need to be available for verification and uploaded into the system. Chiefly, that is the renewable thermal certificates, but other documentation may be required depending on the specific situation. And that concludes Course 10 of the Oregon Department of Environmental Quality's Third-Party Verification Programs trainings. Throughout this course, we've covered key aspects of verifying fuel transactions under the Clean Fuels Program, and we hope this has been helpful for you as you go forward to take the tests and verify our reporting entities. As always, if you have any questions, please contact us at 3pverify@dq.oregon.gov, and thank you for attending this presentation.